why this stock market sell-off might be different. Guys, I did a blog earlier on in the day, you might have already read it, talking about the fact that markets today are very, very risk off. But I want to kind of expand on that and talk a little bit more about how this time things might be different. Because if you look, you know, last couple of weeks, months, ever since mid-March, really, mid-March was the bottom in most global risk assets, you know, after that initial coronavirus panic in financial markets. Ever since then, risk assets have been coming to the upside pretty consistently. And there have been risk-off days, there always are, this is markets, it's up and down. But consistently, there's been a buy the dip mentality. But this time, guys, I'm warning you, it might be different. People might be a little bit more nervous to buy this dip. And I'll explain why. Basically, what are the fundamental reasons we've had this risk rally from those market lows? I think there are three key reasons. I think most analysts would agree. Number one, swift response from the global monetary authority. So that's all the central banks, cutting rates to zero, doing QE, pumping markets for liquidity, all that kind of stuff. Keep markets functioning well. Number two, a swift response from the fiscal authority, so governments basically splashing the cash to try and support employment, to put money in people's pockets, to try and prop up the economy that has been so badly damaged by coronavirus. And number three, obviously we did these lockdowns all over the world, especially in key markets, key economies, that markets really care about. And so far, it appears that these lockdowns have worked, because if you look at the UK, EU, Australia, US, Canada, other major economies, the spread rate of coronavirus has come right down. But one of these key assumptions that has underlined this big rally in the market has started to come under threat. And I did note this earlier in the blog, but I'm going to reiterate it now. In the US, there is growing evidence of a resurgence in coronavirus infections in some states like California, Texas, and Florida is the latest data we got. As a country on the whole, the spread rate of the virus is still coming down because the initial hotspots like New York still doing better. But in these other states that I've just named, it's going in the wrong direction now. And these states have been reopened now for a couple of weeks. So markets are now questioning, hang on a minute, one of our three key reasons for this rally is under threat. Because if there's a second coronavirus wave, that could put us pretty much back to square one, lockdowns reimposed, you know, all that kind of stuff, which would just be terrible for markets. So guys, I'm warning you, in the coming weeks, in the coming days, for the rest of this week, next week, we're gonna have to watch very, very closely the data from these states like California, Texas, Florida, that have been seeing this pickup in coronavirus cases. And if this pickup in cases continues and extends, imagine if we start getting it in Europe as well and other key economies, then expect risk assets to be under pressure. That is why I think this dip might not be bought. That is pretty much it from me for now, and I'll see you in the next one.